Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over some questions on Twitter, some ones that I kind of want to answer and capture. Again, if you want to follow me on Twitter, it's at finding_finance. This one's going to cover an array of whatever questions we kind of find along the way here. But I've got two that I picked out specifically. One's about income. Another one's about uranium seasonality. I know it's not completely correlated, but I'll give you my financial opinions here. Again, I've been working in the industry, aerospace industry, for probably about almost 20 years. So about 20 years in the aerospace industry. Just to give you a little bit of my background, my degree is in manufacturing engineering. I worked as a manufacturing engineer for many years. Then I went into management, supervision management. So I ran new product development. I ran operations. And now I oversee basically the entire operations of an operations area. So that's what I'm doing right now. I've got maybe 20, 25 people that report to me at this current time. And that's contractors and other people as well. Just to give you a little bit of a background. But there's a comment here. I'll give you my opinion. And I look at everything from an engineering perspective, from a value perspective. So I may be a little bit different than everyone else. But it says, yes, the one who makes 50,000 and spends only 25,000 is better off than the one who makes 100,000 and spends 80K. However, the one who makes 200,000 and spends 150,000 is financially better off than both of them combined. Increasing income is the way. Now, I'm going to give you my opinion here and take it for what it's worth. There's a couple of dynamics that you want to think about when you're accepting a job, if you've got income, if you want to do all that stuff. $200,000, and I know that they specifically said spends 150K and then saves 50K is better than both of those outcomes. That may or may not be the case. And let me describe that scenario. As you go to high and expensive states, they obviously tax more money. So it's like running up a treadmill. The higher the tax area, and the more money that is required to make there. So there's a couple of areas in the United States that are high tax and high cost of living. New York, California, to name two off the top of my head, that are pretty high up on the list for cost of living. San Francisco, Los Angeles, wherever in California, it seems like. Now, when you make more money, you get taxed more. The Federal Reserve, or when you pay your federal income tax, they don't care where you live. So that number is just an artificial number. Your savings, if a person makes 200K and they spend 150K, it's financially better off. That may or may not be the case. It depends what your expenses are. If your expenses are really high, then saving twice as much as the other person doesn't matter. And what did it take to get that $200,000? If you're working, and this is the ratio in me, this is the value in me. If you're working and you're working all the time, and your difference in your hours put in of making 100K versus 200K, and you have to double the time you have to work to get the 200,000, that may not be worth it. I don't know how to put a value on trading years of life, especially if it's in your 20s or 30s, for more money. Because when you go and enjoy that money, you're going to be at an older age. What is the value of those years where you are amped up on, we'll call it testosterone and on energy and all that other stuff? What is the value of that? I don't know. That's going to be dependent on each person. But I mean, obviously, the engineer in me says you want to maximize your dollars per hour, because that means that the company is valuing your time more over time as you accumulate experience, and whatnot. And what I see with a lot of jobs is you've got these. There's like a separation line in a lot of these large corporations, guys. And I'm not like pro or anti corporations. I'm just telling you how it is and my experience and what my thoughts are. There's a line in the sand, and in that line, you've got kind of people who they just have jobs, and they go to work, they do their job, and then they go back and kind of check out. Those are like your individual contributor jobs that you see on a lower level. So that's kind of like a engineer level 1, 2, 3, 4, something on the lines of that. Sometimes the upper level engineers get a little bit more involved, work longer hours, and sometimes the younger ones do too. And what you're going to find is, depending on your manager, depending on the company that you work for, it seems like as time progresses, these companies are cutting a lot of benefits. And they can add up to substantial amounts of money. I'm not talking little amounts. I'm talking 100, 200, $1 million over the lifetime that you work at a company. It could be even more than that. That is what you're missing out on. So what are the benefits that they've basically eroded away over the years? Some of these benefits are bonuses. They've removed bonuses. They've had employee stock purchase plans that they've removed. Some of the healthcare benefits have drastically gotten worse. They would have little things like reimbursements that they got rid of, holiday gift cards, holiday lunches and or dinners. There's a whole bunch of different things that they've really scaled back on. Now, if you look at some of these employee stock purchase plans, we had some of those back in the day that I would participate in. Those were worth hundreds of thousands and millions of dollars if you took the full advantage of those programs. And the program that was offered to us back in the day was, you had the first 10 trading days, last 10 trading days. You took the lower of the two, and then you got the stock for 85% of that lower of the two. It was either the first 10 or last 10. And usually if it's the last 10, then you got the next year, the first 10, if it was really low price, and it rocketed higher. That was worth a lot of money. You could put up to $11,000 in it. So $11,000 per year. So that was something that was taken away, and it was, I think, it was a lot of money taken away. And it really doesn't align you with the company if they take all your benefits away, they take your bonus away, they take everything away, and you're like, well, what am I trying to maximize? What you try to maximize then is either you try reducing the amount of work you do per hour because there's no benefit in doing more once you hit a certain region, and or you try to work less hours. I mean, that's what it turns into. So now you're trying to maximize your dollars per hour in different means because there's no benefit in going above and beyond, and there's no alignment to the company. And there's other things that they're doing that I think makes the alignment even worse, depending on a whole bunch of other things. But there's a whole bunch of other things that are tied to this money that you could potentially make. So coming out with this statement, and saying the one who makes 200K and spends 150K is financially better off than both of them combined. Financially, that might be the case, but it may not be the case because it depends on where you live. It depends on your cost of living, depends on what you had to give up in terms of time, effort, stress, etc., etc. 200K at some of these companies puts you at a upper level manager or a director type position. And some of them are easy, some of them are extremely difficult, depending on what position you take. If you're looking for kind of the easiest path, then you want to take a position where you don't have a whole bunch of people under you, you don't have product depending on you shipping it. You really want to be in a job where things aren't as dependable on you, but you might be something where it's like a fringe of where things are at. So, for instance, human resources would be probably a pretty easy one, or continuous improvement, or something on the lines of that, where you could have a small group under you. It's not necessary for you to be there on the weekends. You could come in, you could improve things, and you can kind of leave. And you can assign owners they do this all the time to other people that are in the area. So that could be a little bit easier. Now, if you're directly over things where lines shut down because of you, supply chain, ops managers, stuff like that, it makes it a lot more difficult to kind of side skirt that stuff. So it depends on what you have to give up to get that. And I think the way that you structure your life, the vision that you have for your life, that depends on where you want to go. You got to kind of have to figure that out early, because when you're early in your career, you can kind of set it up where you gain the experience where you want to go. If you gain a bunch of experience in something that you don't want to go that direction, people are going to kind of look at you like, what are you doing? If you want to go and be design and test, why are you gaining all this experience and quality and go down, a separate path? And maybe quality might be a bad one. Maybe it's supply chain, but you want to go into testing or something. And they're looking at you like, why would you go this route? So I just wanted to comment on that. Now, the second question that's right below this, and I says depends on the cost of the income. It says, where's the uranium seasonality? Any thoughts? Well, it's uranium seasonality is just based off of historical movements. And it really doesn't, in my opinion, the seasonality, it doesn't even matter to me. It does not matter. What matters to me is what are the chart patterns? What are the humans putting together? Are we cheap or are we expensive? And if it comes within the next few years, it comes within the next few years. And now everybody gets mad. Oh, I'm waiting in the stock. It's like, guys, that's how investing works. That's how it works. Investing sometimes is ultra boring and it doesn't do anything. So that's why we diversify. That's why we separate our investments. We don't go all in one sector. At least I don't. I know some people, you can overweight a sector. You always be overweight something, but I don't put all my eggs in one basket. And if oil takes off and it massively goes up, that's great. If uranium goes up, that's great too. Uranium had a pretty good run for 2020 all the way till 2021, and we've been in a consolidation period. This is what it feels like. This is what consolidation periods are. It sometimes takes time. Seasonality is just based off statistics, based off of previous cycles. That's all it is. Doesn't mean it has to happen. There is no guarantee. And what we're looking for is is the herd mentality lining this up to go higher? I think it is. It looks good. But you know what? It doesn't mean that it has to go higher. That's part of investing. And you're going to have to wait for the buyers and the money flows to come in. That's what it takes. So that's that part on it. Now, I've got something else too that was real interesting that I was reading. And you know what? I'll pull it up real quick. I'll just talk about it. So it was about Bitcoin. And I was reading Bitcoin and someone brought up to me and says, hey, look, the price has come down substantially. And depending on where you look, if you look at the production of Bitcoin, so the cost to mine Bitcoin for new supply, the cost of new supply is actually going up quite dramatically. I've seen anything ranging from $17,000 something a coin all the way up to $34,000 per coin for the cost to mine a coin. Now, my question, and I'm not a Bitcoin expert, I don't want to be a Bitcoin expert, but my question is, well, what happens if you go below the cost curves of the miners of these things and it stays below it for a good long time? What happens to Bitcoin if miners can't make any money? Does it just get charged to the transaction fees? And if it gets charged to the transaction fees, wouldn't those be astronomically high? And if it stays way below it for a very long period of time, and those fees transfer to the people who are transacting on the system or on the network or blockchain, wouldn't that basically deter people from using it? And if we see higher and higher energy costs into the future, that means that the system itself is dependent on the growth of Bitcoin becoming more expensive. So a cost curve in a cost curve in mining, how that balances all out is you go below the cost curves of the high cost producers, then production gets cut back. Now that very well could be the case of Bitcoin, but if you go below the cost of mining, and these guys just say it's not worth mining and the mining shuts down, that doesn't necessarily mean that Bitcoin is necessary for the function of life or the function of value transactions. It's kind of weird because you cut back silver and people want silver. I mean, that's like something that is a necessity to build things. But if people don't want Bitcoin and it goes below the cost of the mining of the miners, I mean, couldn't this thing all just blow up? So as Bitcoin becomes more difficult to mine, the cost of mining a Bitcoin goes up. What happens if energy and the difficulty of mining go up simultaneously to a price that is astronomically high, and the price of Bitcoin itself goes down because of the market conditions? The market conditions, say in a highly inflationary environment with increasing interest rates and liquidity starts to dry up, Bitcoin tanks down to 8,000 a coin or 10,000 a coin, and your cost goes up to 30, 40, 50,000 to mine it. What happens in that scenario? And if you guys have an answer, put it in the comment section. I'd like to know what your guys' opinions are. I'm kind of curious because I'm thinking about this and I'm like, well, in normal mining, you cut back production and your inventories start to get eaten up at a certain price. But that is with necessary demand to run production and industry and whatever else. And you can do that. The physical thing doesn't lose its value. Everything can lose value around it, and that can still go down, but it would still operate. If you don't have miners in the system that are able to make any sort of money, wouldn't that crash the whole system, or does that cost actually get transferred into the transaction fees? Now, if it's got ludicrous costs to do transactions based off of the network and how hard it is to mine these coins, why would anyone use a network that costs so much then? Is this the weakness of Bitcoin? I don't know. Someone brought it up. I was curious. I did hardly any research into it, but I wanted to talk about it a little bit. I don't hear too many people talk about it. The cost to produce, I mean, in mining, in mining, you go against, if this is your cost curve, your high cost producers, the price comes down and basically can sit and bounce on your high cost producers because you're pulling back production and supply, and the demand may pull back, and you reach some sort of equilibrium around where the cost curves are at, somewhere in the middle of the cost curve or the high cost curve. In Bitcoin, though, it doesn't work that way. It's different. The cost curve of mining and what miners put into it, especially if you're a low cost producer, if you go below the low cost producers, that means mining will shut down. It's not profitable to do it. And I don't know if there's a mechanism to really turn that around, because the supply is fixed in Bitcoin. It's not like you pull back supply. And if everyone's running towards the exit, this thing, I think, would self-implode. If that were to happen, I'm just bringing it up. I don't know, guys. Someone was talking about it. We were talking about it a little bit, going back and forth. And I'd love to hear your guys' answers on how that is being resolved. In a case where you've got runaway costs, because we've got electricity prices around the world going up at pretty good clips, I would imagine that the cost of Bitcoin is going to go up to pretty ludicrous amounts, and the price is coming back down. So if you guys have an answer there, I don't know. I don't have an answer for it. We were talking about it and thinking about that. So, but that's what I've got for today, guys. Hopefully you liked the clip. Definitely click a thumb up on the content if you like it. Subscribe to the channel if you haven't. And if you guys want to check out the website, finding-value.com Platinum membership. If you guys need help navigating these markets, definitely sign up. The Platinum membership gets you access to the question and answer session that we're holding on Sunday, 5 p.m. Mountain Standard Time. And you can ask anything. You can ask about macro. You can ask about specific companies. I chart specific companies for people. I think the value, though, is to see what's in my portfolio, why I'm holding certain companies. Those are the questions that I would be asking. Those are the things that I would dig into. Because there's reasons, specific reasons I own a lot of these different companies. A lot of it deals with the leverage, the size of the moves, or the leverage to the price of the commodity. So if the commodity moves 1x, I get a 3 or 4x move out of it. So I'm looking for more high-cost producers, ones that are going to do stupid cash flows when the price goes up. And they're going to pay down their debts. They're going to do share buybacks, do dividends, be real shareholder friendly, and get paid copious amounts with a lot of share price appreciation ahead of us. So that's what I've been looking for. I let you guys know which one are the cash flow companies and which ones are not. And there's a lot of good value there, I think. I'm basically accelerating your learning. At least my opinion is, my perception is that I'm accelerating your learning light years ahead if you're to try to figure this out on your own. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.